Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at JRAB Holdings.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis.
Yeah, let's do it.
For years, the story around these, hyper-growth super apps was really simple.
Burn cash.
Burn cash, capture market share, that was it. But that narrative has fundamentally changed now.
Completely clipped.
What we're seeing in the latest data is this textbook transition away from growth at any cost to a strategy that is, well, squarely focused on profitable growth.
Okay, so let's anchor that idea right away.
Yeah.
The headline here isn't just top-line growth.
No, not at all.
I mean, yes, Q3 2025 revenue hit $873 million. That's a healthy 22% jump year over year.
And it's 17% even if you factor out the currency swing, so it's solid acceleration.
But that's not the real story here, is it?
No. The number that truly defines this whole turnaround is profit acceleration. If you look at the operating profit metric, what we call adjusted EBITDA.
Right, profit before all the complex accounting stuff.
Exactly. That number soared 51% year over year in Q3.
51%.
To $136 million.
Wait, okay, let's pause right there. Their revenue grew 22%, but their operating profit grew 51%. That's a huge gap. What does that tell you?
It tells you that operational leverage is really kicking in, their fixed costs are covered, but, more importantly, it's the consistency.
How so?
That 51% jump marks the 15th consecutive quarter of growth in adjusted EBITDA.
15.
15. That's almost 4 years of sustained, continuous improvement. This isn't some one-quarter fluke.
No, that's a structural shift.
It's a structural reality.
And you could see that confidence in the management team, right? I mean, they've raised their full year 2025 guidance not just once.
What, twice?
Twice. Now they're projecting revenues between, 3.38 and 3.4 billion.
That kind of double raise, it just signals real deep confidence, especially heading into the last quarter of the year.
And this profitability, it's actually hitting the bottom line now.
It is. And that's what the market ultimately cares about. They achieved a net profit of $17 million in Q3, up over 13% year over year.
So the whole story is consistent, top to bottom.
The entire income statement just confirms it. They are out of the red, and they are focused on generating real cash.
Okay, so the company can make money. We've established that. But if we break this super app machine apart, which parts are actually, spinning the fastest?
Right. Which gears are the most profitable? Let's do a segment deep dive.
Let's start with the core.
That core is deliveries. This is still the biggest revenue source. It accounts for 53% of the total.
Still over half the business.
Over half. Q3 deliveries revenue was $465 million. That's up 23%. So think of this as the stable backbone of the business. It keeps the whole platform running.
And keeps the users locked in.
Exactly.
Then you have mobility, the ride-hailing part that started it all. I was surprised to see it's not just resilient, it's actually accelerating.
It is. It grew 17% year over year to $317 million in Q3.
But the really interesting part in mobility isn't just the revenue, it's the unit economics.
Yes, that's the key insight. We saw transactions grow 27%.
27%.
But the number of monthly transacting users only grew 16%. So what does that spread tell you?
It means they're not just getting new people on the app, they're getting their existing users to use it way more often.
Precisely. It suggests really strong pricing power and just a highly efficient use of their driver fleet. They're making more money from the people they already have.
The holy grail of platform efficiency.
It really is. But here's the really exciting part. The segment that I think fundamentally changes the whole margin profile of the company.
Advertising.
Advertising.
This is where they shift from just being a logistics company to being a high-margin data platform.
That's the perfect way to put it. It's like they realized their drivers were carrying not just people and food, but also mobile billboards.
And incredibly valuable consumer data.
Right. Ad revenue saw a massive 45% year-over-year growth in Q2. It's now at an annualized run rate of $236 million.
And the margins on that must be huge.
I mean, the costs are negligible. It's pure margin expansion, and it's absolutely vital for their future profitability.
And then there's the final piece, their fastest growing bet.
Financial services. This is their play on the underbanked population in Southeast Asia.
And that segment is just surging. 39% growth year over year to $90 million in Q3.
And look at the underlying asset there, the loan portfolio. It's the bedrock of their lending ambitions.
And it exploded.
Exploded. 65% year over year to $821 million.
So it's basically guaranteed to cross that $1 billion mark by the end of the year.
I would say it's a virtual guarantee.
And hitting that billion-dollar milestone, that's a huge catalyst, psychologically and fundamentally.
Absolutely. So we have rapid revenue growth, high margin segments kicking in, and accelerating profit. But we need to check the efficiency.
Right. Is this growth getting cheaper to achieve? Is there real operational leverage?
And the data shows it is getting cheaper. You can see it in the segment margins. For deliveries, the EBITDA margin improved 34 basis points.
So just for listeners, a basis point is 0.01%.
Exactly. So that margin for deliveries at 1.8% of GMV might still sound small, but the fact that it's improving shows they are mastering their logistics.
And mobility is even better.
Mobility margin expanded 50 basis points to 8.7%. This is proof that as they scale, each new transaction is more profitable than the last.
And that efficiency isn't just in the operations, it's top down. I love seeing the cost discipline at the corporate level.
Me too.
General and administrative expenses, G&A, that's your corporate overhead, that actually decreased 10% in the first half of the year.
And they did that while revenue grew 21%. That is massive.
A 21% revenue growth against a 10% cost cut. That just screams discipline.
It's a huge signal that management is running a lean operation now.
So all of this,
Mm-hmm.
this discipline, these margins, it has to lead to the ultimate metric. Are they finally printing cash?
They absolutely are. The company is now self-funding its expansion. The trailing 12-month adjusted free cash flow. So the real cash the business is spinning off is $283 million.
Wow. And the growth on that?
A massive 188% increase year over year. For Q3 alone, it was $203 million. That cash generation just gives them incredible financial credibility.
And speaking of funding, this connects right back to their biggest advantage in fintech.
The deposit moat.
The deposit moat. They hold $1.31 billion in customer deposits across Singapore and Malaysia.
And what's crucial about that is it gives them a really low-cost, incredibly sticky source of funding for their lending business.
So they don't have to borrow from banks at high interest rates.
Exactly. They're using their own customers' cash. In a competitive lending market, that is a huge defensible edge.
Okay. We've laid out a very strong case. The fundamentals, the profit acceleration, the financial health. But every investment has risks. Where do the skeptics see danger here?
Well, the first risk is tied to their greatest strength, the super app model itself. The competitive moat comes from network effects.
More users attract more drivers and merchants and so on.
Right. But there's this persistent concern about aggressive price competition from rivals that could, compress margins, especially in deliveries.
That's a fair point. If a competitor just decides to burn billions to win share, how do you defend against a price war?
You defend with efficiency and stickiness. We just saw the numbers.
Yeah.
They grew EBITDA 51% despite that pressure. They're competing on better economics, not just lower prices.
And the ecosystem lock-in is real.
It's incredibly strong. If you use the app for rides, food, and your digital wallet, the friction of switching to 3 separate apps is immense.
Okay, what's risk number 2?
That would be the fast-growing fintech credit engine. The segment is scaling aggressively, 39% growth, but its operating profit is still negative.
Because of provisions for bad loans.
Right. If loan defaults spike because of an economic downturn, profitability could definitely get hurt.
And the mitigation for that.
It's twofold. First, remember that $1.3 billion in deposits we talked about? That's a huge shock absorber.
A funding buffer.
And second, their provisioning for credit losses is scaling right in line with their lending growth. It suggests they're being prudent, not reckless.
And finally, there's always the big one for this region.
Regulatory risk.
You're operating across Singapore, Indonesia, the Philippines. These are very different, sometimes volatile environments.
It's a standard regional risk. You can't avoid it. But the beauty of the diversified model helps. If, say, Indonesia changes ride-hailing rules, they can offset that with growth somewhere else.
Diversification helps absorb those localized shocks.
Much better than a pure-play competitor could.
Okay, let's look ahead. We understand the story. We understand the risks. What are the near-term catalysts that could drive the stock?
The immediate event is Q4 earnings. That's coming up in late January. This is the big test.
Investors will want to see confirmation of that raised guidance.
That double raise, exactly. They need to see it was met. And any further margin expansion would be a massive positive signal.
And we come back to financial services. Hitting that $1 billion loan portfolio target by year end.
That's a critical milestone, both psychologically and fundamentally. If they confirm that, you could definitely see some fresh, positive analyst attention.
And what about the long-term bets?
For long-term investors, you should watch the disciplined investments they're making in things like autonomous vehicles and remote driving tech. It's years away, but it shows they're not resting on their laurels.
So give us the final word.
Yeah.
What is the distilled bullish thesis here?
Okay. This company has moved past its expensive startup phase. It now offers a compelling risk-reward profile, combining accelerating revenue with truly explosive and sustainable profitability. And this transition is happening across a powerful, defensible ecosystem in one of the world's fastest-growing digital economies.
So the story's pretty simple.
The story is simple. It's the transition from a cash burner to a cash generator, and I don't think that has been fully priced in by the market yet.
So the real question for you, the listener, is whether the market is still pricing this company like a startup, or if investors have truly noticed that the advertising and fintech arms have turned this into a high-margin data and logistics machine. That's the piece of the puzzle to keep mulling over.
If you found this analysis of Drab Holdings useful, make sure you hit that subscribe button to catch our next one.